first 3 months of the year have been reasonable ones for the Momentum Managed Solutions, with all three funds in the suite, Cautious, Managed and Growth, generating returns that are in line with expectations given the market conditions in which we've operated. The Global Cautious Fund returned -0.6% over the month. It was weighed upon by the returns of global bond markets which came off over the period. Nevertheless, the fund was 20 basis points or 0.2% ahead of its benchmark over the quarter. The Momentum Global Managed Fund, the middle risk fund in the range, outperformed its benchmark by over 80 basis points or 0.8%, with a gain of 1.6% compared to 0.8% for the reference index. Finally, the Momentum Global Growth Fund generated the largest absolute return for the quarter at 2.3%, which was in line with the return generated by the global equity market for the period. The good news is that this performance is net of all fees, and that's pleasing for us because this is the actual performance we deliver to our investors. While it may not have felt like it at the time, the global equity market has had a reasonable 3 months, with the representative global index up 2.3% in US dollars, with double-digit local currency returns in Europe and Japan, making up for a lackluster return of 0.8% for US stocks over the quarter. Turning to the bond markets, most major sovereign markets produced positive returns in local currencies as yields pulled in on the back of further central bank easing in the quarter. The US dollar was reasonably strong, and this was enough to push these returns into negative territory when expressed in US dollars. As a result, the funds with the greatest allocation to fixed income, Cautious and Managed in particular, produced lower absolute returns than the Growth Fund, which is predominantly invested in the equity market. In an environment where markets have drifted up but not made significant strides, our view of valuations will not change much. As a result, we've not seen the need to make significant alterations to the investment approach in the funds because we believe their positioning over the quarter is where we want to be looking to the future. As a result, there have been some minor tweaks to positioning on an ongoing basis, but no noteworthy changes in the funds over the past 3 months. The funds remain well allocated to a balanced mix of equity strategies. These strategies have complementary and somewhat offsetting characteristics, which together creates what we believe to be an optimum allocation to the global equity market. We augment this global position with additional allocations to the UK, Japanese and European stock markets, and this is because we believe these markets are attractively valued, and as a result we want to have a meaningful allocation to those markets. On the contrary, we're deliberately underweight the US equity market because we believe it to be expensive. There's a lot of good news priced in the US, and we think there's a greater risk of disappointments either from the corporate sector or macroeconomic data than there is elsewhere. We also make use of a couple of more focused strategies, such as infrastructure securities, Copedix Global All Cap, contrarian holding, and a position in gold mining shares. Within the fixed income buckets, we're underweight government securities and overweight a variety of areas of the credit spectrum, including investment grade, high yield, convertible debt, and emerging market debt. We retain a reasonable cash balance as it represents modest value compared to government debt, and it's also useful to put to work as and when valuation opportunities present themselves. Markets will remain dominated by central bank actions in the months ahead. While the US Fed removed its patience comment at the end of this month's FOMC meeting, at the same time it revised down its growth and inflation forecasts, indicated greater slack in the economy than previously forecast, and dramatically lowered its future interest rate expectations, cutting these by around 0.5% over the next 2 years. So it seems that lower for longer remains the mantra, supported by slower growth in recent months and weak payrolls numbers, increasing the possibility, not yet a probability, of no rise until 2016 of interest rates. At the same time, there is absolutely no doubt that the ECB and Bank of Japan will keep policy ultra loose, and the Bank of England has put back its first rate hike almost certainly until 2016. So the world remains awash with liquidity, keeping bond yields at exceptionally low and highly unattractive levels and providing support for equities. While there are clear risks, none of these appear to be potentially damaging enough to result in a renewed bear market. There will be periods of consolidation, but there are sound reasons for believing that this very long bull market and cycle still has further to run.